Hello, welcome to this week's Market Carver. I'm Andrew Thrasher, Portfolio Manager for Financial Enhancement Group. I'm joined by Zach Unger, Senior Analyst for the Financial Enhancement Group. We have some really interesting topics to go over with you today, looking from ETFs, looking at consumer and government debt, and diving into the significance of both. To get it started, Zach's going to dive into a pretty interesting component of the ETF industry.
Yeah, so early on in the ETF history, when they were launched in the late 90s, through really the mid 2000s or so, predominantly what you would see in the underlying strategy is a passive index-based investment strategy where the ETF would track, call it the S&P 500, the Russell 2000, the MSCI World Index, et cetera, et cetera. Really in the mid 2000s and more specifically in the teens, the 20 teens, we started to see active management come into play in these ETFs where there were specified strategies and the managers of the ETFs would trade and shift the positions in the underlying ETF pretty regularly to adhere to the strategy. In the past 5 years or so, the theme that's come out the most, that's become more prominent, are passive niche ETF strategies. So what I mean by that is you'll have a strategy that tracks an index passively, much like ETFs did in their early years, but instead of tracking the S&P 500 or the Russell 2000, there is a much smaller, much more concentrated subset of securities that are being tracked. For instance, HVAC companies or companies with Bitcoin in their corporate treasury or companies that are domiciled in a very specific small international country. And so the problem that presents is that ETFs, because they have many underlying holdings, present as though they are broadly diversified, which in the case of the S&P 500 or the Russell 2000 is true. There are a lot of companies, they're spread out across geography and sector, and so there is built-in diversification there. But the diversification is lost when the strategy becomes highly concentrated. The kicker with these newer niche strategies is that the managers oftentimes can charge 20 to 30 times the expense ratio or the fee to manage the underlying strategy. So we really just want to make you guys aware that these things are out here. It is a double-edged sword. There is an opportunity for us as active managers to gain more specific access to niche areas of the market that previously were much harder to access outside of an individual equity holding. We can now hold a basket of assets in a specific sector, which is beneficial for us. But for those that just want to hold it as a static piece of their portfolio, it's important to understand what you're actually owning in the underlying ETF and the risk that presents on the downside.
Looking more at the economic side of the market, specifically looking at the rising government debt. So some of the latest headlines have been looking at the passage of President Trump's big, beautiful bill. And with it comes an extension of the Tax Cut and Jobs Act that was originally passed in 2017. With the extension of this tax cut is likely now economists believe going to push our debt to GDP, the amount of debt within the federal government to our gross domestic product, to about 200% by 2055, a level not hit by many other developed countries. What this is assuming is a slowing of GDP growth to 1.6%, which is below our historical average. But as we have a aging demographic and some of the other implications that are slowing down our economic growth, they do believe that we should start seeing a sub 2% normal average amount of growth, which is going to take our debt higher. Well, this is a concern, and this is what gains a lot of attention and a lot of focus. What is more applicable or impactful, I should say, to the market is actually the other kind of debt that we're going to look at on the next screen. And what that is looking at household debt and corporate debt, which is looking much more improved and has a much stronger foundation, as we've really seen both groups, primarily households, really been cutting their debt exposure since the great financial crisis. If we zoom in on this chart, what we're looking at specifically is that red line. What that red line is showing is the total annual growth in U.S. household and business debt. And as you can see, it's actually gone negative, the lowest since the great financial crisis. When we had low interest rates for 10 plus years, as the Fed kept rates extremely low, we saw a lot of consumers and a lot of businesses really take advantage of that refinancing debt, whether it was through mortgages or other types of debt, and really getting interest rates much lower on that debt, taking on less debt, and really improving their overall financial picture. And this is why this is more impactful, I say, to the market, is because this is what flows over to consumer spending, what businesses are able to spend, the ability for CapEx to happen from a corporate side, from companies to be able to increase sales because consumers can have more spending activity, and on as this impacts what corporate profitability can be, as well as consumers' ability to participate in the economy. And so this is why we think this is more important as we discuss the market and discuss the impact to what U.S. stocks are doing, more so than what we believe is going on the federal side. While we do believe federal debt is a concern and is important, we believe it's less important from a market perspective than what your balance sheet looks like and what the balance sheets of corporate America looks like, which so far has continued to be improving for the last several years. We hope you're able to join us next week, and we'll dive into some more of the topics that we're discussing every Monday in our allocation meeting with our advisors. If you have any questions, concerns, or you'd like to set up in a meeting, we please encourage you to either reach out to us by the phone number on your screen, the website listed there as well, or you can scan that QR code, and we'd be happy to set up a meeting with one of our advisors at any time that's convenient for you. Thank you so much, and have a good day.